Today on Media Mula, the podcast where we dive into the future of media with a focus on monetization and growth, we'll be discussing about a new venture model, which is called Media Capital Investment. And I'm very pleased to welcome Diana Florescu, CEO and founder of Media Growth. Hello, Diana, and thanks so much for joining us today. How are you doing?
Hi, Ron. I'm really good. Thank you so much for having us. Really excited about this conversation today.
And I'm very excited too, because to be honest, it's actually the first time I'm going to talk about this topic on my podcast or on my LinkedIn. I never talked about it on my newsletter neither, and I'm pretty sure that it's going to be a new thing for my audience too, for my listeners. So I trust that your expertise and your background will make the subject super comprehensive for the audience. Before we get started, who is Diana?
Sure. Well, we'll do my best. Well, I always I suppose I would be leading with my introduction into the business that I run, but I interestingly enough I spent actually the last 10-15 years of my life in tech. So before building Media for Growth. So you could say that I'm a person that is very passionate about supporting small businesses. I always worked with small businesses across the board, but consumer is definitely it just has a very special place in my heart. I had my own startup, failed. So I've gone through that whole process of starting and closing a company. It was back then it was in a space that is very popular nowadays, is getting a lot more attention, and that's food waste. And through that experience and also working early on in a gaming company, so in a very entrepreneurial, fast moving space, that propelled me to different accelerators and venture building studios. So I worked with a lot of companies over time. I've seen a lot of the challenges that founders experience as they grow their brand. And I consider myself quite entrepreneurial, I would say, and always looking out for new innovation and ways to make things more efficient. So 3 years ago, I founded Media for Growth. We are a media capital investor, and it very much happened as a response to the market trends that we were seeing at the time in terms of consumer investing and the very dynamic and very exciting world of media that I'm sure we'll be discussing today. Putting that aside, so wearing kind of a personal hat, I grew up in Romania, in Eastern Europe, born and raised. I left when I was pretty young. I went to the UK to study, so I did my studies in London. And very early on, I think just 2-3 years into my studies, I started traveling mainly for studies at first and then for work. So I spent the last 10 years in between 6 countries, from Poland, which is a very interesting space at the moment, is growing a lot and it's becoming a formidable tech hub, to Germany and places probably quite surprising maybe to your listeners, like Qatar, Doha, which again, back then, 3 years ago, was a fantastic place and it's scaling a lot, to now sitting in New York, talking to you, where we just opened up our office with Media for Growth here just 3 months ago. So yeah, pretty exciting time.
Congratulations.
Thank you. Yeah, it's been a great journey for the past 3 years, and we're very excited about what's coming up ahead.
Mm-hmm. Cool. So before we dive into the what is media capital investment, sorry, I'd like to, if possible, if you could give us like the state of the media industry. What's happening right now? What do you see?
Yeah, great question. I think just to kind of take a step back and in terms of what we call media capital, what it stands for, it's a form of investment where publishers, broadcasters, essentially any media platform with significant reach can invest their assets, the advertising space, in what we call consumer brands or emerging brands. That investment essentially is an exchange of advertising space. Sometimes it also comes with expertise or other strategic services on our side for ownership in the brand. How we got to this space and what is happening right now in terms of investments and the growth we've seen. I think I always like to contextualize this investment model into a broader category, right? I mean, consumer investments, VC investments have been around for decades. And then the media world, the media industry, it's an industry. It's a $750 billion industry. So it's a fantastic space. There's been different changes and dynamics impacting both sides of the market that have led to what we call media capital. On one side, looking at the media space, a lot of traditional publishers, broadcasters are obviously feeling the pressure from big tech companies like Google and Meta and Amazon. In the last 10 years, they grew to take 60% of the advertising revenue. So 60% of advertisers' budgets go into these tech platforms. And there's a lot of change happening also when it comes to television, right? Linear TV in some markets is declining. I say some markets because, if you're looking at Eastern Europe or Central Europe, or even Spain or Italy, right? People spend on average 4 hours a day watching actual TV. But then places like US, already connected TV, addressable TV is driving pretty much the revenue spend, right? So as a result of that, a lot of these broadcasters and publishers were looking into ways of diversifying revenue, attracting a new set of advertisers, and also finding a way to be part of those really exciting journeys of like the next unicorn, right? You see companies that are coming out of nowhere and then, with, 100 million valuation, like, okay, how did we miss that? How did we miss that train? So I think that this trend has only been increasing as a result of the trends I mentioned. But on the other side of the consumer space, which creates this perfect storm for media capital, consumer founders have been challenged by the current fundraising environments. A lot of the VC money don't actually end up with consumer brands. I think the recent study we published, we saw that $1 in $16 goes to a consumer brand, as opposed to, I think, $2 in $7 or $3 in $7 5 years ago. So what happens is that a lot of these brands, they still need advertising to grow, right? They're still spending. We did a study, we went through about 100 K1 statements, and 40% of their revenue goes into advertising. They're not going to stop necessarily spending on advertising. But what happens, they normally just stay with Meta and, Google and the other platforms I mentioned. It's easier to measure. Also, a lot of people know how to use it, right? But then they're missing out on a big opportunity to amplify their brand. And this is driven by the financial challenges that I mentioned, but also sometimes the expertise. So media capital, essentially the way to look at it, it's almost like a venture model, but also a solution to addressing both sides of the platform, both sides of the problem. A way for broadcasters and publishers to diversify their revenue and get access to new advertisers, and for consumer brands to accelerate that growth, working with strategic partners, specifically above the line media partners, but doing it in a way to optimize their marketing costs, right? And extend that operational runway. So I think it's a very interesting time for this model. It's only been around for, I would say, about 2 decades. That's when it was when it started to be institutionalized in Europe. Europe is still the biggest market for these investments, also in terms of volume and media capital deployed. But US is also we're at a very interesting time here. So a lot of the publishers and even our media partners, our LPs here in the US, they see a fantastic opportunity to use this model. in accelerating the next set of companies. So we can talk about that later, but I think it's definitely, we are at a very interesting inflection point with this model right now.
So you mentioned that for once, actually, the European market is in advance, is ahead of the US in terms of this model. How do you explain that?
Well, I think good question. And I also just want to, I guess, clarify that I think investments in a form of media for equity have happened in the US before. And probably even 10 years ago. It's just that they were not structured or institutionalized as we've seen it done in Europe. So most likely there was an opportunity, or they were done rather opportunistically inside the media companies. The reason I think Europe is leading, or has been leading this trend, well, it's mainly because I think the available cash for the companies, for the startups, right? US historically and continues today, the valuations, the ticket sizes that you can raise, even at a pre-seed seed round, are significantly higher than what we have in Europe. It's just a lot more capital available for deployment in the market than in Europe. So as a result of that, I think a lot more consumer brands were looking for creative options, I suppose, in terms of optimizing that spend. It's also interesting to probably observe when it actually started, and that started during the dot-com bubble back in the early 2000s. So it was a very interesting dynamic at the time when there was just not a lot of money in the market. So it almost came as a necessity to just accelerate growth on both sides of the platform. So I think it has to do with a lot of the cash available in the market. And US is definitely seeing that. I think there's now we've gone through 3 cycles of some of these funds, right, for the last 2 decades, and there's a lot of success stories, a lot of unicorns created, a lot of companies that have a fantastic survival rate that have raised this media capital. And now US is paying attention to that, right, and trying to incorporate this into a more institutionalized structure.
Just to give the listener maybe something really concrete to understand, can you give us some example of funds or how it works, basically, like in a very
Sure.
concrete way?
Yeah, absolutely. And I would also probably ask you if you've seen anything like this in France, right? You're in Paris right now. I don't know if you've seen it among some of the media companies.
No, actually, it's really new to me,
Yeah.
which I'm a bit like I'm a bit ashamed because like I'm supposed to be like really on trends and see what's happening in media, but no, I just saw your one of your probably a post on LinkedIn or something mentioning your company, and I thought like, oh, this is interesting, and then I tried to do some research and we got in touch, so that's how I know.
Yeah.
But it's really new to me actually, to
I
be
think it's
completely
new to a lot
transparent.
of people. No, it's new to a lot of people, and I think, and this is why we need an media for growth, and we'll discuss that. It stands for a lot more than just our investment platforms, and
Hmm.
we do these investments, right? We operate similarly to a fund, but we set up to do a lot of research and a lot of events and try to bring this model, essentially just make it more accessible, right, for both brands and media companies. And then in terms of funds that have been doing this, and they're probably the most well known in Europe, we always give credit to Aggregate Media,
Hmm.
which is a fund set up in Sweden. I think Patrick, who runs the fund, if I'm not mistaken, I think they're going through the 12th cycle right now. They've done over 400 investments. And it's a very clever way, the way he's structured. I mean, this is the first fund that was ever created in Europe, and is actually not backed by a media. I mean, it's not a media corporate that is running it, right? So naturally, you would think that a media group would probably create a fund like that or invest off the
Hmm.
balance sheet, right? Because it's a natural extension. Where this fund, it operates, or we'd rather operate very similarly to them. They're independent. They have multiple media companies that commit allocation to the fund, and then they act as a GP, right? So aggregate, I think, very fascinating structure, and I think a very clever model. German media pool in Germany, but they've also done other cross-border investments. They have a very similar structure, so another independent fund, over 40 media partners all across Germany. They've done it for about 12 years now. They're also an investor in Media for Growth and one of our venture partners. And then you have media groups that are very innovative, and they kind of jumped on this train early on. So let's say Channel 4 Ventures in the UK, VNA started this back in 2016. They've done a lot of investments, and even in companies that now are public listed, like Pinterest. When the company expanded to the UK, they've done a first deal with Channel 4, and Airtasker more recently, which is a company listed on Australian Stock Exchange. So these are some of the funds. We're seeing a lot more independent funds being launched in different markets. Markets like Brazil, so emerging markets. We're getting a lot of interest from Latin America as well. And yeah, definitely US, which we're already doing here right now.
Okay. Can you give us an example or a few examples actually of like deals that you've done?
Yeah, absolutely. So we scale in the US only in the last 6 to 8 months. So a lot of our work has been done in the UK and supporting companies from Germany, France. Actually, we have companies that have gone through our programs from 10 countries. But here in the US, we set up, as I mentioned, three months ago. We raised $30 million from two of our major media partners. And the first investment, so we started deploying right away, is in a company called LA Golf, which is a designer manufacturer of golf clubs and golf shafts, completely manufactured here in the US. So it's kind of born and raised here in the US, but the brand is quite international. So they have an international presence in UK and many other countries. We're really excited about this deal, also because of what they stand for as a brand. So they go after the unconventional player. They're just building the best sports equipment, period, right? So you want to play golf for the fun of it and not follow the industry standards. Well, you should probably look into LA Golf. They have the best shafts, right? From an IP technological perspective. And it's interesting that another trend we observed, there's a lot of celebrities and a lot of influencers that are getting involved in this type of deals, either being an investor on the cap table or exchanging some form of media influence for equity. And the same thing happened to LA Golf, right? So they're backed by Bryson DeChambeau. He's one of the golf players. So we basically added, through our investment, we've added national presence, national reach through one of our partners, Sinclair, across specific sports channels and shows and key markets across the US. So yeah, really excited about this one. And we have at least, I think we're looking at probably about 7 to 10 investments for the rest of the year. There's a couple more coming out very soon.
So in terms of the brands that you're working with, it sounds like it's more you call it consumer brand. Can you clarify what it means?
Yeah.
So how is it different from like typical brand? Sorry.
Absolutely. No, it's consumer brands. You're perfectly right. And what consumer means to us, it could be a consumer tech platform like a marketplace, to a more traditional CPG brand like even LA Golf, I would say, right? They have a physical product, or it could be food and beverage, or fashion, for example, or cosmetics, right? In the end, the way we assess a company, it's very similar to any other investor. So we, of course, we're looking at the growth, the traction. Typically, we would invest in a company with annual recurring revenue of about 5 million, because we normally don't invest less than 1 million in advertising. But what is really important, and that's probably very different from how a VC would look like at a consumer brand, is the relevancy that they have with our media properties. Can we reach the audience that you're targeting through our properties? Do you have the distribution? Or if you don't have a physical distribution, because you might be a consumer tech platform, do you have then a good product market fit and a great UX, or the ability to fulfill orders if it's a D2C website, for example? And this is a very important component, right? Because then in the end, we are a media capital investor. We invest advertising space. And the success of the brand is obviously the success of our fund. So we will always start the assessment with, that initial pillar. How can we support that brand in the most optimal way to amplify that reach in specific markets through the properties that we have available?
Understood. Now, if we turn to the media side, I'm guessing that you're more interested into reaching media group that have like TV, radio, internet, print, rather than just like digital first media? Or is it like a wrong assumption?
I think so. We can work. The way I would look at it is a media partner that has significant reach and premium advertising, whether that's a digital platform or a broadcaster or a publisher. In the end, we're looking at having a very diverse media stack, so all of them essentially apply. It's also, I think, important to look at the size of the company, right? Because we normally, the way we invest and how much we invest, we have to work with a media company that is relatively established, right? So that they can allocate anywhere between $1 million to $2 million a year at least in advertising, right? So if it's a small, let's say, publisher that is very specific on a very specific sector, that's probably might not be the right approach unless we're building a cluster of other publisher in that specific sector. So naturally, we're going after larger groups. I think there's so much innovation happening right now that we're going beyond the obvious one. So retail media, it's a fascinating place. The players are, I think it's going to be. I think if publishers, broadcasters right now are feeling the pressure of digital media, I think very soon they're going to start competing with retail media. Another space we're looking at is mobility advertising. So what I mean by that, maybe I don't know how much is in Paris, you let me know, but if you look at actually New York, if you go into, I don't know, city center, and if you look at the cabs, you'll find, the billboards on cabs or inside Uber, Lyft, right? These are all digital screens operated by independent players. So the end goal for us is to build the most diverse stack of media. And if you are a media partner that is looking to reach new consumer brands and also cross borders, right? US, UK, Germany, France, essentially you're having one entity that you can work with, right? And that's Media for Growth. That's why we are set up to be a global platform for these investments.
Understood. You touched a bit about the influencer space. Is that something that you're looking at, like, to do something separate, or you're looking to do some deals? Because I read today, actually, or yesterday, that Mr. Beast now is making more money with his chocolate brands rather than with his media or influence properties. So I'm guessing, like, for consumer brands, like let's take again the chocolate example. You have like a chocolate brand or CPG. You could really, I think, apply the same model with influencers, but again, there's one Mr. Beast. So I'm not sure, like, it's something that spike your interest, or if it's something that you're just thinking, oh, it's cool, but like, it's not really scalable. Or how do you think about it?
No, it's highly scalable. And I think, I mean, there's no surprise that even our investment in La Golf came with essentially a celebrity on the cap table, because at least in the US, this is almost becoming the norm. Whether that celebrity or influencer is vested through a form of cash, or they exchange, or they have another strategic partnership, there's always a link back to a celebrity. I think it's extremely strategic for us in terms of our media capital deployment strategy. I see a lot of talent agencies becoming almost the role of a GP. So they're managing a lot of celebrities and influencers, and they're starting to structure deals within the group, right, within the company. There's a lot of celebrities that have launched their own fund, right? I mean, we probably, obviously, everyone talks about Ryan Reynolds right now. He's a very successful entrepreneur, but very clever the way he's been using, right, his influence. You talked about Mr. Beast. I mean, Mr. Beast was 5 years ago, I think 4 years ago when he started. What he was posting on YouTube, his content would have made him the top 10 most watched Netflix shows if you were taking Mr. Beast into a TV show on Netflix. So not surprised. I think the opportunity and equally the challenge is to obviously identify the right people, right, to associate with your brand. And you have to, we can't work with individual, influencers that have 100, 200,000 followers, although they might be very, very strategic, but we got to do it in a very structured way. So we're looking at that space and working actually on something right now.
Okay.
But it is a trend that it will can only grow as the way we look at it from an investment perspective.
Interesting. If we circle back to the media, what are the benefits for media to apply this model? When we prepare this interview, you told me that a lot of them would like to probably optimize their ad inventory, but it's not the only benefits. Can you walk us through the benefits for media?
That's right. And I think we've done, and a lot of things I'm saying, we are trying to back this with facts as well, right? So we, just a couple of months ago, we ran a first fund manager survey. So we interviewed a lot of these media companies to understand exactly your question, Ron. What benefits do you see? What returns do you see? Do you see any returns at all? And about 60% of them actually have already started seeing actual financial returns, the returns that you are getting from these investments, because in the end, we're investing for financial returns, right? Like any other investor. The multiples are very similar to what you see with a VC fund, right? So I think there's first of all, there are obviously there's a financial gain. That's one benefit, but usually that financial gain, of course, comes at a point of exit. For some funds, maybe they're a bit more patient, and it would take 7, 8 years. For some others, may exit perhaps sooner, but that's more of a long-term revenue stream, right? The way I would look at it then, and then we asked as well, what are the more like short-term benefits for you? Now, the diversification of revenue comes from a couple of different ways. When, especially as a public listed company, when you do such investment, our experience has been that they are recording this as top line revenue. So you are recording the value of the investment. There's an invoice, you record it as top line revenue. Obviously, that has, a multiplier effect when it comes to signals to market, stock, and so on. At the same time, there's also immediate cash opportunities that media partners get exposed to by working with these brands. What I mean by that, a company, a brand may actually use their production capabilities to create a TV ad, or may decide to actually pay in cash for certain brand experiential or activation ideas in the market. So there is always short-term revenue, along the way. And then I think the access to, you mentioned already optimizing inventory, but the access to new advertisers, I think it's a very intriguing point that a lot of media companies immediately see value. The likelihood that their sales teams will come across the brands that we bring, it's close to zero, because these are companies that have never thought about going to TV. I think very often, and I think the challenge that remains is that a lot of these brands still need to be educated about why should you think about brand advertising in the first place when you've
Hmm.
got, Meta and Google.
Sure.
And that's what we do, right? So we're not just an investor or a passive investor. We create specific sprints and programs where we essentially start with these questions. How can we create, for example, the most strategic plan? What else do we need to optimize your campaign? Why should you be doing this? So I think these are like the 3, 4 main reasons. I would say diversification of
Hmm.
revenue, financial returns, new set of advertisers, completely new to the brand, and as you
Hmm.
rightfully said, optimization of ad
All right.
inventory.
I'm guessing for the digital media that you're working with, it's
Hmm.
easy to, I mean, easy. The first thing that comes to mind would be probably to use the unsold inventory as well, unsold ad
Hmm.
inventory for your for the brands that you're working with. But
Yeah,
is that a risk to sold the ad inventory that is unsold basically, or is that like a good thing? Do you see the same return basically? Return.
I see what you mean. So I think so when we talk about remnant inventory, there's this is a very good point that we always want to clarify. It's if it's unsold, it's not unsold because you're getting a 3 a.m. TV spot on a channel that nobody is watching. As I mentioned when we were talking about linear TV, especially, these publishers are competing against Google, right, and Meta. So
Mm.
you naturally have a lot of more inventory that has to be optimized. In the end, it will be sold. It doesn't get unsold. It's just that the way
Okay.
that it's being sold is not very, probably in our opinion at least, media capital investor. We always try to make the case that this is probably a better use of your ad inventory rather than putting it on programmatic and getting cents on a dollar.
Mm.
Because that
I see.
happens, right? So if there is unsold inventory with publishers, you would probably look at getting some money back rather than, wasting it and you're putting it on programmatic. Our ask essentially is, well, invested in a ambitious brand that could return your spend, your investment, I don't know, threefold, fivefold, right? So the way we approach this with a brand, we create a media plan because we have a dedicated media planning team in house, like any other cash advertiser would get. So there's no, less premium advertising space to a brand that does media for equity compared to a cash advertiser in that case.
Understood. In terms of your company, Media for Growth, you mentioned that you have like a few competitors and they all have their own structure, their own belief,
Mm-hmm.
probably, their own way to see the market, where it's going. How is Media for Growth structured? And if so, how is it structured differently to other funds?
Sure.
And what's your vision for this
Yeah.
market?
So it's interesting you mentioned competitors, and sometimes from the outside, it may seem like we could be competing with other funds.
Mm-hmm.
It's actually the opposite. So when I started Media for Growth 3 years ago, we initially started as an association. So we wanted to be the industry voice authority, if you like, for all the media capital investors to come together, see how we can support consumer brands, exchange opportunities, work on research, and just really building the best platform for brand advertising and for supporting consumer funds. And as of today, we're still working with all the funds that I just mentioned earlier, right? So
I see.
we work with them in different capacities, whether it's on deal flow exchange and co-investment to having more strategic partnerships like with German Media Pool, for example.
Mm-hmm.
The reason I think Media for Growth is perceived like that is because it was always set up to be a global platform for media capital investments. So if you're a fund in Australia, for example, Scale Up Media Fund, you can work with Media for Growth or you can work with Channel 4 to be able to co-invest in similar brands. The way we're structured, in the US, we are similar to a pledge fund. So we're not a fund officially. The media partners give us an allocation that happens usually on an annual basis and then for foreseeable few years. But we tend to have a relatively strict allocation per year. And then Media for Growth identifies the top brands. Our media partners have a say in this, so they have a veto right. And then we go ahead and make the investment. So Media for Growth is the entity sitting on the company cap table, but our media partners basically get exposure to a diverse portfolio, and the brands get exposed to multiple partners through one single entity. At the point of exit, we would split the proceeds between us and our media partners. But the whole process from investment to due diligence, reporting, and even overseeing the exit, it's done by Media for Growth. And media partners like that because sitting on the company cap table and overseeing that process makes it a lot easier for them from a legal compliance standpoint, operational as well speaking. It basically reduces the cost for them to get started with that model. So we like to talk about us being an outsourced venture partner in a way, right? So if you are, let's say, a publisher or a broadcaster that is very new to the space, it's almost like a plug and play model, right? You're not subscribing to a fund like an LP would, so it's a lot more scalable than a more rigid fund structure in that case.
Understood. And from your side, is it harder to convince advertisers to get on board or media? Or both?
Great question. I think so let me say this. I don't mean to actually exaggerate, but we don't really get a no from media partners. It's usually if they don't do this right now in the US, it's just a matter of priorities. So it's not a matter of we don't want to do it. It's a matter of when we're going to get started. And that's because I think, again, we're only providing a solution to some of the challenges that already exist out there, right? I mean, they're looking at Media for Growth as an extension to their corporate strategy team and agenda. Media on advertisers, I think the challenge, and I think the challenge still remains. So maybe if you want me to really answer the question, I'll probably say sometimes it would be challenging to find a really good brand. And that's because of the educational piece that we still need to do. We're not essentially selling media capital to them. That's not the pitch that we're making. We're trying to explain why should you think about investing in above the line media and your brand, even if you're 2-3 years into your journey as a brand. A lot of companies think that they need 8-10 years to be able to go onto TV. That's not the case, right? And also TV doesn't cost millions to get started. So there's a lot of preconceptions. And I think because of that, sometimes it just makes it more challenging to have those conversations. But I think we're in a place where it's easier now after 3 years of a lot of work that we've done in Europe and UK.
Understood. And I'm guessing that for this type of consumer brand that you're working with, that you're partnering with, the digital versus the television is digital is you can track the performance. You put like a $1 or €1 into Meta, and you know how much you get in sales. Same with digital advertising in general. It's not like performance marketing or affiliate marketing, but more or less, with TV, it's more of a challenge. So it's less natural, I guess, for this type of brand that are really accustomed to and really keen on following the budget to invest some media dollar, media investment into TV. So is there a way to track actually? I'm not specialized at all into like TV advertising. I don't know anything about it. So I'd like to know from your point of view, how do you track performance on TV advertising?
Yeah, of course. So there's way to track. I think it's also about managing expectations and if you're expecting to get the same level of granularity and measurement as you find on Meta, obviously that's not the case for TV. Usually you have to give it, some time. You can see immediate impact in terms of website traffic, right? Or app installs. And there's specific platforms like Realytics, Innovid, which I think got acquired, TV Square here, iSpot TV. I mean, there's big market of measurement platforms out there. In the end, the methodology is kind of similar, right? So you can track the exact impact 6 minutes after your TV ad has aired, right? So they're doing that across all your TV ads, and you can see exactly, translated into website traffic. And then later on, of course, looking at bottom line revenue, right? Has that increased? What we normally see is, with specific categories that also need to build trust, we normally see an increase average purchase value. There is, as a result of establishing trust, there's also increased distribution, or the cost per acquisition actually goes down, right? So there is a way to track it. That's one thing, even on linear TV. The other thing to say, though, TV is not just linear, right? So we're talking about addressable TV, connected TV, which it gets even closer to what they know in terms of performance channels and tracking and measurements. So that gives you a level of targeting, which is, I would say, pretty phenomenal, right? You can go down to like 2 letters of the postcode to some extent. But then there's always a danger, I think, when you try to do that with TV, which intrinsically is a mass media channel. The question is then, is that really the best use of your budget? Because you do want to have enough of a big of a universe of people that you want to reach, right? When you're trying to be so targeted. We always say there's no really such thing as a waste on TV, right? Because you may reach people that perhaps are not necessarily within that main target audience, but then you're only paying for who you want to reach, right? So if you're paying for a campaign to reach 25, 45 women, health conscious, and you're advertising a sports product, then any other woman that you reach beyond that, or that, you're only paying for that specific category, but you get exposed to a much bigger universe. On Meta or Google or whichever, which by the way, also the costs are increasing right now, right? You're only paying you pay for that specific audience. You don't get anything else out of that. So these are 2 things on measurements, and there's additional benefits for doing above the line, beyond just the revenue or installs or orders and so on. And the ones that I mentioned earlier in terms of distribution, establishing trust. We see a lot of these brands being able to close partnerships with retailers if they have a physical product. Because again, it comes as a point of, okay, I've seen on TV. It's almost like this is a point of establishing trust and brand authority. And that helps sometimes just make some of these partnerships, the whole sales process, going much faster. Fundraising as well, right? We very often co-invest with cash investors. So yeah, I think it's definitely still continues to be a challenge, but also the market is changing a lot, and there's a lot of providers that provide this level of measurements.
Interesting. So what's happening for you guys in France? Are you active in France? You mentioned that you're working in Europe. So what's happening in France, and how do you see the French market?
Yeah, so France has always been a very interesting place for media for growth, and continues to be. I think now more than probably in the last couple of years. Some of our partners are in France, so we work with RTL and M6. In fact, last year we awarded $1 million worth of advertising to 2 major brands, and that prize was pulled together with M6, RTL Spy in Germany, Channel 4 and ITV in the UK. So we, for the first time ever, actually, we, not just us, but I think this hasn't been done before, to bring 3 biggest markets in Europe together to support these advertisers going cross borders, which was fantastic. NCIS has so this is a shout out to them. They do have a very interesting program, which is the MCIS program. So powered by MCs, which supports small businesses in getting started into TV. So all the level of support that I just mentioned earlier, they do provide that in France. And RTL has a very strategic role with us, also including France, because RTL Ad Alliance is an international powerhouse of the RTL group. So if a brand wants to scale from UK to France, for example, want to get access to specific market insights, for example, you're a marketplace of furniture, maybe you want to see what's happening in France, then you get access to competitor spending, insights, different production capabilities and so on through that level of partnership. I think France is only going to grow in relevancy for us. I actually just spoke this morning with a French VC, investing in a lot of consumer brands. BPI is doing a lot of support for these brands. They were just in Austin. I just met up and I presented to a French delegation, a couple of weeks ago from the day we're recording this podcast. And we're actually looking at a French company to invest potentially in the next couple of months. So cool. I think we'll do a lot more in France. We're hoping to get more media companies interested in this model also in the French market.
Hopefully they will be listening.
Yeah, we hope so.
To close the podcast, I always like to ask the prediction for the future. So I don't know if you want to take this question really like on a general scale, or like if you want to focus on your expertise, which is media capital investment. I leave the choice to you.
It's a good question. I think at this point, I don't know. I'm curious. When you ask this from your other guest, does it get political in any way? Because I feel like right now, everywhere you look, if you open The Economist or if you open a BBC, it's all about US politics. So I maybe we can stay away from that.
Sometimes it gets political, but usually I try to focus the question and to ask the question in terms of the guest expertise.
Sure,
but I always leave the door open as well. So really feel free to go wherever you want. What do you see and what excites you the most about this industry actually in terms of prediction, the future, and
Absolutely no, I'm just kidding. Definitely not. I don't want to go down the political path. I think we're bombarded with a lot of negative news already as we are. So I think predictions for media capital, I think US is definitely going to become the largest market when it comes to this investments volume as well as deployment by 2030. I think there's going to be a lot of exciting categories within the consumer space that we haven't seen that much, perhaps in, coming forefront before. So some of the sectors that we're looking at is also real estate, for example, and, consumer ways of disrupting that space. Even if it's from platforms like connecting independent architects to residential and families, right? Building your home, as an example. Looking at a lot of the healthcare. So the healthcare space is also a fascinating space. There's a lot of growth in telemedicine and what we call kind of self-home medicine. So anything that allows the end consumer to address certain health challenges at home. So we're looking a lot into that space. And then also equally sports. Sports is probably going to be commercially as well. I mean, there's so much happening coming up in the US right now with the Olympics as well. And the fight for sports rights, it's pretty obvious. And I think there's a lot of opportunities in also supporting the next generation of sports brands. So I'd say overall, the way I look at it, I think the future looks pretty exciting for this space. I think there's always challenges in trying to stay innovative, right? I mean, diversification of media is key. Although when we're looking at the market trends, we're actually seeing sometimes an opposite direction. There's a lot more consolidation happening in the market, right? The US media seems very fragmented, but in fact, there's only a handful of companies that are really controlling, right, a lot of the media space. So It's going to be it's interesting and equally challenging, but that's what makes it an interesting space to be in. So.
For sure. For sure. Well, Diana, thank you so much for your time. I know that you had a busy day full of call already, so it's not easy to record a podcast after like a few hours on the phone already.
No, it's
So
been my pleasure.
I really enjoyed it, and I learned a lot actually. It's really new to me again, and it's really interesting. And I'll be following your LinkedIn as well. And I think you have some reports as well. You publish a lot of like information
That's
and
right.
content about this space. So I try to put as much information as possible in the description of this podcast. If listeners want to get in touch with you, what's the best way to contact you?
Yeah, LinkedIn for sure, or
LinkedIn?
just drop me an email. I'm at
Yeah.
diana@mediaforgrowth.co.
Mm-hmm.
And it's been truly a pleasure. I think every time when I, hear people that are interested in learning more about this model, conversations like this, I mean,
Mm-hmm.
they're absolutely, what can move the needle. More people have to know about this, and I really appreciate the opportunity to present this to French listeners, especially to the media partners and the publishers, because I think this is what the podcast is about, right? You are essentially
Sure.
allowing more publishers and broadcasters to know about ways to monetize their revenues and their
Exactly.
advertisements. So,
Yeah, and it's a big challenge right now for all of them, for sure. So I hope it will be a good fit for Media for Growth. If some publishers are listening, for some medias are listening, again, I'll put your contact detail into the description of this podcast.
Thanks, Ron. Pleasure.
Thank you so much, Diana. Bye-bye.
Thank you. Bye.